Warren Edward Buffett. Widely regarded as the best investor of all time, Warren Buffett is no joke. His company Berkshire Hathaway has ownership in some of the most recognised brands out there, be it Geico, Duracell, Heinz, Coca-Cola and Apple. Yet in recent times Mr. Buffett has failed even to beat the market, a benchmark any competent professional should exceed. So, with that said, this is why Warren Buffett fails to beat the market. Now, when people call Warren Buffett the best investor of all time, it's not for no reason. The man's investing wisdom is timeless and still far superior to the crap they teach you on finance courses. In fact, let's hear some of that wisdom now.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price, but prices don't tell me anything about a business.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Incredible. In case you didn't catch that, what Mr. Buffett is saying is that you shouldn't freak out about the short-term day-to-day fluctuations in price. Most of the time, the hypothetical intrinsic value of a business is detached from the price variations Wall Street traders cause. And after all, shares are just fractions of a business.
We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. It's a confession, in our view, that you don't really understand the businesses that you own. You know, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that.
I don't think I could have said it any better. Contrary to popular opinion, diversification is not the way to get ahead, and in fact is a tactic that I believe should only be used by the knowingly incompetent. Buffett is right on the money when he says it's madness for a sane person who can value a business to diversify as much as the average investor does. It's for that exact reason that near 100% of my net worth is in Tesla stock. I doubt that there is a better, safer and more obvious investment out there right now. Clearly, this is great advice. Truly great advice. And it's advice yet to be taken by the overwhelming majority of investors, especially institutional and professional investors. But this begs the question, why has the author of such great wisdom underperformed for the past 10 years?
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM? Which
Never owned
has been
IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me.
There it is. Let's listen to that again.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
Is that all right with you?
It's okay with me.
Clearly, old man Buffett doesn't invest in technology because he doesn't understand it. Buffett is from the legacy world. No wonder he can't beat the market. Disruptive innovation by its very nature is all about replacing the legacy way of doing things, and Buffett has fallen victim of an embarrassingly common human flaw, choosing the comfort of the familiar over the unknown. Yet one thing is very important to be aware of. Just because something is personally unknown to you does not mean it's unknowable. That leads us to the real purpose of this video. I didn't make this to crap on Warren Buffett's substandard returns. I made it to say what he, or any other investor, should do about it. So, what can you do about it? Well, the first step in combating ignorance that I always take is to search the internet for advice. In Buffett's case, this might require buying an up-to-date personal computer or smartphone, but that's besides the point. If we're talking specifically about combating ignorance of disruptive innovations in technology, your best bet is to familiarise yourself with the unofficial experts on disruptive innovation, ARK Invest. In fact, that's exactly what my previous video was all about. I also highly recommend familiarising yourself with Tony Siebert and his think tank Rethink X, which further explains the mechanisms of disruption. Once you're aware of the mechanisms of disruption and improvement under Wright's law, you're more or less good to go. Investing doesn't need to be some complicated affair filled with weird equations and Greek letters. In fact, common sense, a desire to learn, and a basic understanding of disruptive innovation are all that's really needed to get ahead. Even discovery and data analysis can be done by essentially copying ARK Invest's homework, though, of course, don't blindly take their word for it. With all that said, it should be easy for anyone to learn to understand new technological disruption, and Buffett has no excuse. Anyway, that's how you can get ahead by investing, and this has been why Warren Buffett fails to beat the market. Thanks for watching. I hope you found this both entertaining and informative. I'm planning on making a video about the sort of mindset you should have as an investor, so let me know if you want that. Also, read the description and information cards for more information. Anyway, that's all I have for this video. I'll see you in the next one.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics, you mean professors of
right,
finance?
Yeah, the data is there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail.